Welcome to the Greater Central Florida Multifamily Investor Group, where we focus on investing where it makes sense. Hello, everyone, and welcome to the Greater Central Florida Multifamily Investors Group meeting, where we focus on investing where it makes sense. I'm your host, Ismael Reyes, and the purpose of this group is to learn from and help each other do multifamily deals with a focus on Greater Central Florida assets or potential investment partners. We're here today to talk about a very important topic. Like I mentioned, for many, this is very critical, and especially those folks that do have, that are wealthy, how to reduce our taxable income. And no, this doesn't mean we don't give to those in need. For example, I'm a longtime donor of Children's International. What it does mean is we decide how to best help instead of completely leaving it to the government, which, and for someone that's was in the government for 28 years, I would know that we don't always do things in the best way. Let's just put it that way. We mean well, we do the best we can, but at the end of the day, I think individuals know how to best spend their money, know how to best help others that maybe are close to them that are in need. And in fact, the government incentivizes small business and real estate investors with reduced tax liability. And why do they do that? And the reason is the people that are getting these tax benefits are the motor, of the motor that keeps this economic engine going. Yes, we have, huge corporations and all of this, but at the end of the day, it's the small business owner, is the real estate investor that is really, keeping things running smoothly. And I'm going to let our special guest, Ted Lanzaro, to talk to us a little bit more. So I think what I'd like to do next is actually just go ahead and introduce our guest. I'm going to go ahead and introduce Ted formally and then essentially hand it over to him for a presentation that will hopefully put some money back in our collective pockets. So Ted is a CPA, real estate investor, and real estate broker. So a triple whammy there. Yeah. And he's also an author and a speaker with 29 years of real estate tax consulting and investing experience. He runs Lanzaro CPA LLC, a boutique CPA firm specializing in accounting and taxation for the real estate industry. For the past 30 years, he has helped thousands of real estate business owners, entrepreneurs, and investors all over the U.S. implement cutting-edge tax strategies that save them thousands of dollars annually on their taxes. Ted is the author of the Tax Smart Landlord and the Tax Smart Landlord Toolkit, as well as over 100 articles on taxation for the real estate industry specifically for landlords, investors, flippers, and developers. And I know this for a fact. He's a sought after speaker. I appreciate you being on our show. You've spoken all over the U.S., and we're glad to have you, Ted. I appreciate it.
Ray, I'm thrilled to be here, man, and love to do these kind of things and share, some strategies tonight. And so I appreciate you having me on. Thank you so much.
No problem. That's my pleasure. So you've got the con, man. So I give you control of to be able to share, and we'll go.
Let's talk tonight about tax planning specifically for real estate investors, and we're going to talk about how you can do things towards the end of the year that will make a difference in your taxes. So let's so I'll tell you just a little bit about myself. I've been a real estate CPA for 30 years. I've been an active investor for 20 of those years. I lived in South Florida. When I started my career down there, I used to live in the Boca Raton, Delray Beach area. And I was working for a CPA firm at the time, just getting started out, my first 5-6 years in the business. And I went to high school down there, and a buddy of mine came up to me and he said, listen, we got to read this book. He said, we got to start investing in real estate. And the book was Rich Dad, Poor Dad. And it was a book that, has launched, about a zillion real estate careers, right? And so I had been working in the tax department of a firm that did a lot of real estate work. A lot of my clients were were real estate developers, and I saw what kind of money they were making. I was like, oh God, I think you're right. Let's get into this, right? And the first day we went out, I read the book and I agreed with them. And the first day we went out with an agent, we put a contract on 3 single-family houses in Fort Lauderdale. So that was our first. And that turned, by the end of the year, we owned around 10 houses in the Fort Lauderdale area. And man, we had made every mistake in the book. You know, we had put our names on every one of the mortgages. So, you know, instead of, you know, being able to spread out the mortgages, both of us were on everything. And eventually we, you know, kind of, we were rehabbing properties. I was going to Home Depot to get the paint for the contractors, right? You know, I was doing everything. We made all the, you know, didn't really know what the heck we were doing. And eventually that turned into us buying some garden style apartments down in that area. And then we started flipping houses. And so it was a lot of fun, and I learned a lot. And I did that as an active investor up from about the year 2000 to about 2017. And in 2017, I just decided that, you know, enough was enough as far as the active investing goes, because, you know, my kids were getting older and I wanted to spend my CPA firm was busy, and I wanted to spend some time with my family. You know, I've been working, you know, really hard for, you know, quite a bit of time. So I took all of the knowledge of the investing and all the tax strategies that I was using, and I wrote this book called The Tax Smart Landlord, and I used it to basically build a national presence for my CPA firm. At that time, up until that time, I had been pretty localized to Connecticut, where I live now, where I moved back to Connecticut in 2006 and started investing there, and then worked as an investor in Connecticut and the CPA for up until about 2017. And then I wrote the book and I started building like a national practice. And now I represent hundreds of investors all over the country, all buying, in a lot of cases, mostly buying multifamily. So real heavy specialty in multifamily, but also shopping centers, office buildings, self-storage, mobile home parks. I've got a client who's buying RV parks all over the country, right? So I'm learning all about the RV park business, which is kind of really cool. So this is the book, The Tax Smart Landlord. You can get a copy of it at on it's actually landmarkcpagroup.com now. But if you go to Lanzaro CPA, it just puts you on that website. We just changed the name of the firm. I brought in a partner to help me with the tax work. So we have a new name, Landmark CPA Group. But you can get a copy, you can get a digital copy of this book on the website for free, and you can also buy it on Amazon, the actual copy for like $14. So here's what we're going to talk about tonight. We're going to talk about how to maximize and safeguard your tax deductions. We're going to talk about the sort of holy grail of investment real estate, which is qualifying as a real estate professional and what that means. We're going to talk about maximizing depreciation with or without a cost segregation study. We're going to talk about how to maximize your retirement plan and how to work with what's better, an S Corp or an LLC. We're going to talk a little bit about that. We're going to talk about Roth conversions and how to kind of towards the end of the year, because this is important. Because if you do a cost segregation study and wipe out your income, there's no better time to do a Roth conversion than when you have very low income, because you pay the minimum amount of tax to be able to convert your traditional IRA to a Roth. We're going to talk about repairs and improvements and why it's better to have a repair and sort of my granular approach to that. We're going to talk about using entity structure to reduce audit risk, and then we'll answer some questions. So the first thing I want everybody to know is that everybody's different. And at Landmark CPA Group, what I do is I tailor tax strategies to people's individual situations, because the same strategies that might be good for Ray may not be good for Kevin, for example, right? Or vice versa. And there's all these different kind of things that are different about people. Are you a W-2 employee or are you a business owner? Do you work in the real estate industry? Can we qualify you as a real estate professional? Are you a landlord? How many, if so, how many units? Are you actively managing, or do you have management companies? Everybody's different, right? Are you married, single? How much is your income, right? Because if you're an active investor and you earn over $150,000 a year at your job, then you get phased out of a lot of the tax deductions that are available if you make under 100,000. What are your goals? You know, there's a lot of times when I can do tax planning for people and get their income down so low, they'll never qualify for a loan, right? So when you're building a portfolio, you know, sometimes you have to pay a little extra taxes, you know, to be able to keep your income high enough to be able to build your portfolio. So it's not always, you know, lowest possible taxes. I mean, I've found that out the hard way when, you know, clients complained that I've reduced their taxes too much, right? They couldn't get a loan, right? And what kind of investor are you? Are you a passive investor? Are you an active investor? Or are you a real estate professional? So let's start with that. So before we go there, let's talk about the process of maximizing and safeguarding tax deductions, because all good tax strategy is built on good record keeping, right? You wouldn't build a house on quicksand, right? And you can't build your financial house, your tax strategies, investment strategies on bad record keeping. Because if I'm doing tax planning for you, I need to be able to look at your numbers and know that I'm looking at good stuff, so that when I go and run projections and tell you, look, use this strategy, use that strategy, this is how much it's going to save you, right? Then I'm looking at good information. Otherwise, it's a garbage in, garbage out system, right? So we want to make sure we're looking at good stuff. So having a good accounting system that captures all of the activity of the property, say for example, is just a must, right? Keeping receipts and important paperwork, very important. Documenting repairs and renovations with pictures. We're going to talk a little bit about, you know, cost segregation and renovating properties. I have a very proactive approach to taxation. We do, in my office, we do what we call year-round tax planning with our clients. And what that basically means is anytime any of our clients are going to buy, sell, or renovate a property, I want to hear from them. And the reason I want to hear from them is because not only am I going to tell them what tax strategies they need to put in place in order to minimize their taxes on that for that transaction, but I also want them to do things like document the repairs and renovations. So just as an example, if you're going to rehab an apartment building, right? Well, you should, absolute must, go in and take before pictures, right? And then have your contractors, they're throwing away major components of that building into a dumpster, you know, right? Have them document that stuff, right? Why? It's a write-off. When I buy a building, right, and I go in and I renovate and I pull out things out of the building, right, then those things, I paid for that. Let's say I go and buy an apartment building for $1 million. I paid for all the crap that's in there and that I'm going to throw away. So when I throw all that stuff away, I'm actually entitled to a deduction. I'm actually allowed to reduce the cost basis of that property by a reasonable allocation of the stuff that I'm throwing away. So how am I going to document that? I'm going to take pictures. I'm going to literally take a picture of it in the dumpster, right? Another thing that a lot of people miss, a lot of investors miss, is sending 1099s to your subcontractors, right? You have subs that work on your properties. If you pay them over $600 a year and they're an individual, an LLC, or a partnership, you need to get a 1099, right? Which means that at the very beginning of your relationship, you need to get a Form W-9 from that, right? And if you don't, after you've paid them and they've done the job and they're long gone, good luck trying to get them to send you their tax ID number so you can report them to how much income you gave them to the government, right? So you do it up front. It's part of good, it's part of a good record keeping and management system. And you never know when you're going to need that kind of information if something happens. So there's a whole, like, just as an example, when I was, you know, actively managing my properties and actively rehabbing properties, you know, we had whole files. If you were working as a subcontractor on my properties, we had a whole file on you, We had, subcontractor agreement, we had your 1099 information, we had your insurance certificates, we had everything, because that's part of, running, first-rate organization where you're going to, do everything on the kind of the up and up. And if you don't, and I know a lot of people don't, it will come back. I could share several horror stories with you about some of the things that happened to my clients when they didn't do things like that. And then the best part is never missing any administrative expenses, right? A lot of, and we're going to talk about administrative expenses, but a lot of investors, they know they can deduct the property tax, the mortgage interest, the insurance, right? All the obvious stuff, but they miss a lot of the miscellaneous stuff, the administrative stuff, the miles to and from the property when they're managing it, or, some travel expenses, allocation of cell phone, allocation of internet, things that you can do. So we'll talk a little bit about that. So there's essentially three types of investors. The first type of, and what we're really talking about here is your ability to deduct rental losses against your ordinary earned income, whether it be W-2 income or business income, right? So a passive investor is an investor who is putting his money into a deal basically for a return on investment, right? He has no management responsibilities. He has no liability. Typically, he's either a limited partner or he's an active investor whose income exceeds $150,000 a year, so he's phased out of any ability to deduct. Passive investors cannot deduct rental losses against their ordinary W-2 or business income. Okay. Any losses they have will carry over to future years where they will be able to use it against either their net rental income in future years, or, and Ray, this one was, you were talking about capital gains before, you can use your passive losses against any capital gains that you have from rental real estate sales. Okay, so whenever you sell a property, if you have passive loss carryovers, you can offset the capital gains with those. So that's an important piece of information. The second kind of investor is the active investor. The active investor is the guy who has a small, maybe a large portfolio, has a portfolio of properties that he or she actively manages, right? So they're the property manager, and they're doing a lot of the work. They're professional landlords in a lot of cases, right? Now, being an active investor means that you can offset up to $25,000 a year of rental losses against your ordinary income. So if I'm a W-2 employee making $100,000 a year and I have an active rental portfolio that I manage, I can take up to $25,000 a year of rental losses, mostly from depreciation. I'm not actually losing money. I want to make sure you understand that. I'm making money, cash flow, but I'm using depreciation to create tax losses that I can then offset against my income. And we'll talk a little bit more about that. So what happens is I have $100,000 worth of income. I subtract my $25,000 of rental losses. Now I only have to pay taxes on $75,000 of that income, right? And I still have the cash flow from the rental properties in my bank account. So it's a very good thing. If you're an active investor and your income exceeds $100,000 a year, essentially you lose 50 cents of the ability to take losses for every dollar you make over $100,000. So if you make $130,000, you lose the ability to take 15 of that $25,000 loss, right? You're going to be able to take $10,000 of losses against your ordinary income. And there's a lot of tax planning strategies that we use to get that W-2 income back down below or as low as possible, right? In order to be able to take rental losses. Just think of this. This is actually pretty cool. So let's say we got a guy who's making $115,000 a year, but he's not contributing to his 401k, right? So now this guy would be limited to be able to take rental losses against, a lot of his rental losses against his ordinary income, right? But if we can, let's say he's making $120,000 a year, so he's losing $10,000 of that ability. But then we tell him, okay, listen, next year, here's what I want you to do. Max out your 401k, right? And use the cash flow from your rental properties to pay, help you pay your bills, because maybe you don't have enough money to, to fund your lifestyle if you make that 401k contribution, but use that extra rental income that you're getting, right? To do that. And then what ends up happening is now their income goes from 120 down to 100, right? So what do? They decrease their income by 20,000 by making that 401k contribution, and they increase their ability to take rental losses by 10,000, right? So now instead of going from 120 to say 110, they're 105. Now they're at 100 minus 25. They're back down to 75. Right? So it's really so that's where the planning comes in and being proactive and knowing what you're making and how to get that number. So if you're an active investor, you want to try to keep your income, if your income is in that range, use strategies to get it as low as possible to be able to maximize the rental deductions, because it's a double dip. You're going to get a reduction in your taxable income 2 different ways. So that's awesome. Now the holy grail.
Ted, do you want questions as we go or at the end?
Sure, whenever you know what, I don't have any agenda, man. So we can just take them as we go if you want. So if you want to read them off, let's go.
Yeah, so I guess one that's pertinent to this is as far as what is the minimum number of hours to qualify as an active investor?
So to qualify as an active investor, you want to have 500 hours of managing your properties. Okay. What's good about that, right, is unlike the real estate professional that we're just going to talk about, the 500 hours you can do between you and your spouse. So it doesn't have to be just you. It can be you and your spouse can accumulate those 500 hours, right? Now, if you're a real estate professional, which is sort of the holy grail, because real estate professional status means that you can take unlimited amount of rental losses, primarily from depreciation, against your ordinary income. In order to qualify as a real estate professional, you have to work at least 750 hours in a real estate related business, and it has to be more than half of what you do. So if you've got a W-2 job where you work 2,000 hours, you have to work 2,001 hours as a real estate professional in order to qualify, right? So that's really difficult to do. What ends up happening is W-2 employees who try to claim real estate professional status are basically putting a bullseye on their back, right? But your spouse can qualify if you file jointly, right? So I have a lot of high income professionals as clients who have spouses who are not W-2 employees, are not working. And so what they do is they get them involved in the real estate management. They get them involved in managing the portfolio. They get them involved in being a real estate agent. They get them involved in raising capital. All the various, there's a lot of different things. One of the biggest ones, and especially down in Florida, they get them involved in short-term rentals. Short-term rentals are probably the easiest way to build 750 hours as a real estate professional, because they're management intensive. There's a lot of activity that goes into into managing short-term rental properties, right? So it's a really easy way to get build up your 750 hours. What happens, and I'll give you an example, is like I have a client who I just did some planning for him the other day, right? He's a commercial real estate broker. He made like $600,000 this year, right? He bought an apartment building in February, and we did a cost segregation study on it. And he bought a small apartment building, about $1.5 million, and he's going to get like $300,000 of bonus depreciation this year, and he's going to be able to take that as a loss. So now he can offset his $600,000 worth of commercial brokerage income by $300,000 of depreciation losses. So now he only has to pay income tax on $300,000, right? That's literally, in his bracket, that's literally over $100,000 tax savings. right? And we've been planning this now, from the beginning of the year, right? Now, the other thing that he can do is he can put away like almost $60,000 into his SEP, right? So when all is said and done, the guy who made $600,000, bought an apartment building and maxed out his retirement plan is only paying taxes on $240,000, right? That is literally $130,000, $140,000 tax savings, right? Especially if you live in, you guys, a lot of you guys live in Florida, you don't have state income tax. Here in Connecticut, not only is it cold, but we got to pay 5% income tax to live up here, right? So, and that's not that expensive compared to, say, California or New York or New Jersey, right? So anyway, so this is what we were just talking about, the real estate professional status. So a couple of other things, like when I'm advising people on real estate professional status and how to do real estate professional status, a lot of it comes back to record keeping, right? Because you need to be keeping a time log of your hours in order to document the fact that you've worked at least 750 hours or more in the real estate business. And people use it, just a simple spreadsheet. But what I tell people is the more specific you can be, the better off, the better your log is going to be, right? So I have clients that say, they'll write met with realtor an hour, right? No, met with realtor Joe Smith, telephone number 203, blah, 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 regarding the property on 123 Main Street, right? Be specific. And then you should have a file where when you met with Joe, you took pictures of 123 Main Street, right? And if you made an offer on 123 Main Street, you should put the contract in there, even if it wasn't accepted, and keep a file of these documents, right? The email trails discussing the property, maybe you made an offer, right? All of these things should be in a file, because these are the backup documents that if you ever called into the IRS's office, right, you would need these documents to be able to say, hey, I'm a real estate professional. And think about the guy I was just talking about with the 100,000 plus tax benefit, right? Now, he's at a pretty low risk of getting called in, but isn't that amount of record keeping worth the $100,000 tax savings, safeguarding the $100,000 tax savings, right? So what qualifies? What kind of business activities qualify? All the activities related to the operation and marketing of your real estate business qualify. And typical real estate businesses that qualify include development. So if you're a developer, you qualify. Redevelopment. What does redevelopment mean? Flipping. People buy houses, fix them up, and sell them. Are redevelopers, essentially, right? If you're doing real estate conversions, where you're taking an old warehouse and turning it into apartments or something, right? Then you're a developer. You're doing conversion. Any kind of construction, acquisition. So if you're doing syndications, you're acquiring properties. If you're a real estate broker, a real estate agent, if you're doing property management, right? All of these activities qualify as real estate related businesses that you can earn. Professional landlords, right? All of these businesses qualify. So let's talk about how do we achieve our goal of maximizing our rental losses if we qualify as real estate professionals, right? Well, a lot of this comes down to a few things. It comes down to two things, actually. Cost segregation studies and what are called abandonment studies, which is just a cost segregation study that you do when you're going to renovate a property. Now, a cost segregation study is a depreciation study where you allocate the component pieces of an apartment building down to their IRS classification, their proper IRS classifications, using an engineer and an appraiser to do so. So typically what happens is, let's say somebody goes out and they buy $1 million apartment building. They don't do a cost segregation study. They bring it to their accountant. Their accountant's going to typically use something we call the 80-20 rule, right? And the 80-20 rule means we're going to allocate 20% of the cost of the property to the land and 80% of the building, and we're going to depreciate the the 80% building portion over 27.5 years, and we're going to get something like, you know, a $33,000 a year depreciation deduction every year for the next 27.5 years on the property, right? And there's nothing wrong with that, right? And if you're not a real estate professional, and you're either passive or you're high income and you can't take the losses, then that's perfectly fine. But if you have the ability to deduct the rental losses like my commercial broker client did, then you absolutely want to do one of these studies, because in $1 million building, the national average of assets that are subject to bonus depreciation in year one is about 25%, right? So on that $1 million property that we allocated $800,000 to the building, we're typically going to get something like $200,000 worth of 5-year and 15-year asset reclassified from the 27.5 years. 5-year property is what we call tangible personal property. It's anything you can, the simple definition is anything you can unplug, unscrew, detach, and walk out with, right? So think about an apartment building. It's in the kitchen, it's all the appliances. It's the kitchen cabinets, the sink, you know, in the bathrooms, it's the vanity, the tub, the toilet, the mirrors, the lighting, shelving, you know, anything I can detach and walk out with is considered 5-year property, right? And so what the engineer and the appraiser do is they go in and they document all the 5-year property in each of the units of an apartment building. There's another category, which is 15-year depreciation, also subject to first-year bonus depreciation, called land improvements. And land improvements are all the stuff on the outside of the property, the fences, the parking lot or the driveway, right? The sidewalks, not the one in front of the house, but the ones that go up to the units, right? Interior sidewalks. Shrubbery, right? Retaining walls, anything outside the sewer lines, right? Are all 15-year land improvements, right? Now, what happens is about 25% of them get reclassified in year one, and then they're subject to bonus depreciation, which means we can deduct 100% of the cost of those assets in year one and create this large loss. That's what my client did, right? So it's a fantastic way, if you qualify as a professional, to be able to take those. Now, so if you've got, like, for example, right now, if you've got a big capital gain, right, and you bought a property this year, if you got a big capital gain from a sale of a rental property, and you bought another property this year, you definitely should be thinking cost segregation. Why? That bonus depreciation will offset that capital gain. That's something you could literally do, and you don't have to do it by the end of the year. You just have to do it by the time you file the taxes, because you're going to need that information to be able to file your taxes, right? So everybody who bought a new property this year should be evaluating whether a cost segregation study will help them, right?
So Ted, I got a question. It says, for passive investors, is the benefit of cost segregation only the ability to carry it forward and offset the capital gains tax at that sale?
Typically it is, right? But let's say I'm a passive investor who this year, one of my passive investments got sold, and now I'm getting passed through a big capital gain, right? Now I can use the passive loss from the new syndication to offset the capital gain from the old syndication, right? I also can use, if I'm a passive investor and I have an active portfolio that has net rental income, I can use losses from syndicated deals to offset my active net rental income in any year. And I have clients that do just that, where they have mature portfolios of properties that are throwing off, you know, $100,000, $150,000, $200,000 a year of net rental income, because the depreciation's all gone. They've owned these properties for 20 years, right? Well, now they can get into a syndication a year, right? And they can wipe all that net rental income out, even though they're passive investors, right? So if you can't use it against your net rental income, and you can't use it to offset capital gains from the sale of real estate, even from other passive deals, well, then you carry it over until that property sells or until you have an opportunity to use it on one of those two things. Now, an abandonment study is a cost segregation study that you do when you're about to do a massive renovation on a property. So if anybody is in a situation where they end up buying like a real value add property, you buy an apartment building that is literally requires massive renovation, right? With the idea that you're going to renovate it and stabilize it, increase rents, and turn it around, right? And there's a lot of properties like that out there these days, right? So first thing you want to do is you want to document what's in there, right? Why? Because remember I said you take the tax deduction and you throw things away? Well, that's what an abandonment study does. If you're doing it on a single family house, you just take pictures of what you're throwing in a dumpster. If you're doing it on a $10 million apartment building, you do an abandonment study. So I had a client who bought a $7 million property in Lexington, Kentucky a few years ago, and they were going to do a big renovation on it. So they did this abandonment study, this cost segregation study. And what they documented was that they were going to throw away $1.5 million worth of stuff that was in the property, you know, all the old cabinets, all the old appliances, all the old toilets and stuff, right? So they threw all that stuff away and they documented it, right? What happened? You got $1.5 million tax deduction in year one, right? Now, it didn't reduce the cost basis of the property? Absolutely, yeah. So the cost basis of the property went from like 7 million down to 5.5. So what? It went right back up over 7 million after they did all the renovations because they put all new stuff in, right? So not only did they get the $1.5 million tax deduction in the first year for the abandonment study, they got the cost segregated tax deduction the following year on all the new stuff. That's super cool. So over the first 2 years of that property, they got over $3 million in tax deductions.
Another question that's related to that. So it's cost segregation, but it talks a little bit about the basis pieces. One of the folks on the call was planning to do a cost segregation study on a 7-unit apartment, but believes that he read that by doing so, the basis of the building will go down quickly, and any future capital gains will be much larger once at the sale. Is that accurate?
Yeah, that's completely accurate. Right. No, that's 100% accurate. Right. So what we're essentially saying is yes, every time you take depreciation, whether it be all in 1 year or in little pieces, it reduces the basis of the property. Right. But the thought process, so cost segregation is a time value of money play. Right. And the longer you hold the property, the more benefit you're going to get from the cost segregation study. So I always tell people, for generally speaking, you want to hold at least 5 years, right? Because if you sell after 5 years, right, you're going to pay that money back, the recapture of the depreciation back, right? But the money, if you saved $50,000 in year one and you got to give it back in year 5, the money you give back in year 5 is worth less money than it would have been in year one, right? And you got to use it for 5 years. Okay, so it's a time value of money play. Now, there's also an arbitrage component to cost segregation. What I mean by that is the maximum, right now, the tax law says that the maximum you recapture at ordinary income rates capped at 25%. Okay. So it's the ceiling is 25%. Let's say I have a really high income year and I have the ability to use a cost segregation study. And as a result of that cost segregation study, I'm going to take my income from, well, let's take my client. He took his income from 600,000 down to 300,000. The income that he was taking down was all high bracket income. The bracket between 300 and 600 is a 30+% bracket, right? So he saved, say, let's say it was 35%. He saved 35% of 300,000. Okay. Now, when he goes to pay it back 5 years later, he's paying it back at 20, even if he has the same amount of income, he's paying it back at 25%. So not only did he get the time value benefit, he got the difference between saving at 35% and paying back at 25%, a 10% arbitrage difference, right? So I could make an argument in that scenario that if you're, let's say you have and a lot of people have this, where you have a really high income year, and then the next year is going to be a really low income year, even if you're going to sell the property the next year, right? So we've done this before where somebody deducted at 35 and then literally made no money the next year and recaptured at ordinary income rates. And if your ordinary income rate is 15% because you didn't make any money the following year, well, that's where you recapture, right? So you can get literally a 20% spread in a year on a cost segregation study if you do it right. But this is where, and this is why when I say call your CPA, if you were my client, I would say call me before you buy the property. Why? Because we're figuring all this out, right? As you're doing it, and we're talking it all out. We're putting these strategies in place during the year before you buy the property. You want to do, we'll talk about 1031s later, but you want to do a 1031 exchange, you don't call your accountant and 3 months after you sold the property and say, hey, I want to do a 1031 exchange. It doesn't work that way, right? You have to do it. It's all set up before the property closes, right? So it's the same thing. This is what we call year-round tax planning. We're talking about all of this stuff during the year, right?
And if you're a full-time real estate investment professional, how does the cost segregation study play? Is it I'm assuming it's even better because you can write off everything.
You write off everything, right? That's my real estate broker client who literally made 600 grand and paid tax on 250, 240, something like that, right? So yeah, depreciation is nothing more than the rational allocation of the purchase price of the property. So it's really important that if you qualify to take the depreciation benefit, that you do it. I mean, it's there, right? Don't miss it, right? A lot of people miss it. A lot of accountants, believe it or not, probably 80% of accountants don't recommend cost segregation studies to accountants, right? I've been doing cost segregation studies since the mid-90s, right? It's like it was and there was no bonus depreciation back then. People were crazy just to get 5 and 15 year treatment, right? They'd go nuts when you tell them, I could do that. Yeah. Oh, that's awesome. You're like, incredible, right? But it's having somebody on your team who is specifically in the business of real estate, right? So there's a lot of real estate specific accountants out there. And you just have to, you just have to find a good one that you're comfortable with, right? Because we will save our clients. I save my clients far more money than they ever can. Almost everything I do is return on investment, right? So good. That's the good news, right? We've talked about a little about this deducting items that are disposed of. So let's talk a little bit about something you could be doing right now. Just making sure right before the year end, maximizing your retirement plan and health savings accounts, right? If you still have some payroll left, or you're running a business and you haven't maxed out your retirement plans yet, this is the time to do it, right? Because you absolutely want to the extent that you can afford to fund them, you should always be funding them. These are great deferral programs. You can self-direct them, so you don't have to. If you don't like investing in the stock market, you don't have to. You can self-direct them. You can buy cryptocurrency these days. You can buy real estate. You can invest in syndications. All kinds of things you can do with a self-directed retirement plan. There's two kinds, traditional or Roth. Traditional is I take a tax deduction when I put the money in, the money grows tax-free. And then when I take it out, I have to pay taxes on it. A Roth retirement plan, the money goes in after tax, but it still grows tax-free, and you don't have to pay any taxes on the way out. So a lot of people like the Roth plans, right? Now, you can also convert from traditional to Roth, right? And when you convert from traditional to Roth, you typically have to pay the tax on the amount that you convert. So when you have a really low income year, it's an excellent time to do what's called a Roth conversion. Basically taking, so I have a guy who this year actually has zero taxable income, right? Because he made about $100,000, in his business, and he has an apartment building that he's going to be able to take like $200,000 worth of depreciation, right? And so he has $100,000 loss. His taxable income is negative $100,000, right? So now this year we're using that negative $100,000 to do a Roth conversion for $100,000. Wow. Because it brings his taxable income to zero and he pays zero tax doing it, right? So that's a great time. We can even if he had zero net income and he converted 100 and he only had to pay tax, he had taxable income of 100. That's still 15% tax bracket, right? So that's about the zero. Obviously zero would be the cheapest way to do the conversion. But anything 15% or lower is a bargain, right? Anytime you can convert your traditional IRA to a Roth IRA for less than 15%, you should jump at that opportunity. The same thing goes as far as funding goes to your health savings account. If you have a high deductible insurance plan, max out your health savings account every year, right? Ultimately, hopefully you never need it, but it's there. The government's giving it to you. It's what you were talking about earlier, right? The government incentivizes behavior, right? So take it to the extent that you can afford to do it, put that money in there and defer it. And there's no reason to pay taxes on it if you still have room in it. And these are things that you can do at year end just simply by looking at where you are and then putting the money in to max fund it. Right? So this is a cool one. This is really for business owners and for people who are maybe doing flips, right? So there's typically when you run a business, you do it in one of two different ways. You either have an LLC or you have an S corporation. When you use an LLC to run an ordinary trade or business, okay, then you're going to pay self-employment tax on every net dollar of money you make, right? So if I own an LLC and I make $100,000 a year, I have to pay, before I pay federal and state income tax, I have to pay a 15.3% self-employment tax. What self-employment tax is if you remember when you were a W-2 employee and they took Social Security and Medicare out of your check, right? You were the employee and they took Social Security and Medicare out of your check. Before your boss sent it to the government, they matched it, right? So now when you're self-employed, you're both employee and employer. So you have to send both sides of your $100,000 of net income to the government. So that's on 100,000, that's 15.3%, $15,300 right off the top, right? And then the minimum federal income tax is 15%. So that's another $15,000. And if you're living in a state like Connecticut, you guys lucky you live in Florida, you get the sunshine and no personal income tax. But in Connecticut, we have cold weather and a 5% income tax. So I would pay another $5,000, right? So now what do I got? I just made $100,000. I paid $15,000 in self-employment tax, $15,000 in federal income tax, and $5,000 in personal income tax. So I'm literally, that's 35,000 of my 100 right there. You know the expression, you work 2 days for the government and 3 days for yourself? That's exactly what they're talking about, right? Because so in order to get away from that, right? you can use what's called an S corporation. And you can elect to have your LLC treated as an S corporation. And there's some rules, and if you have partners, it gets a little more complicated. But if you're a single member LLC, and you're making over $75,000 a year net income, you really should consider converting to an S corp. Why? Because what the S corp rules say is I can pay myself a reasonable salary, and typically we use 50% of net income, right, as a reasonable salary. And then the rest of the money we can just take out as a distribution, a draw, okay? And the draw is not subject to self-employment tax. So when you do your payroll, essentially you're paying the self-employment tax, but you only have to pay it on 50% of the net money you made, not the whole 100,000. So on this $100,000 example, you would pay tax. You would have a $50,000 salary, pay the payroll tax on that, which would be $7,650, half of the $15,300, and you would save $7,650, right? So it's like almost a no-brainer strategy, but every rose has a thorn, right? So the thorn with electing S corporation is two things. One, you have to run payroll, right? So you're going to have to hire a payroll service in order to do that. If you try to do it yourself, I guarantee you're going to screw it up. The first time you screw it up, you're going to realize how inexpensive a payroll service really is, right? Because the penalty you're going to get is going to pay for, a year plus of your payroll service, right? So use a payroll service, and then you have to file a separate S corporation return. Whereas with the LLC, you could put it on Schedule C of your personal return. With an S corp, you have to file a separate return. Typically, if you're running a decent sized business, that separate return is going to cost you about an extra $1,000 a year. But even if let's say the payroll service costs you $500 a year, so even you save $7,600, you have to pay $1,500 a year in professional fees. You're still $6,000 ahead of the game. The more money you make, the bigger that gap becomes, the more tax savings it is, the more it makes sense to be an S corporation over an LLC, right? So we typically, if somebody's in that scenario, we take a look at which is going to benefit them the most. Now, here's the cool thing, right? You're supposed to file an S corporation election within 75 days of the beginning of the year in order for it to be valid by the end of the year, or for the whole year. So if you wanted to be an S corporation for 2021, for example, you were supposed to file an S election by March 15th, 2021. But there is a provision for you to file a late S election, right? And to qualify for that has gotten a lot more lenient because of COVID. So if you're sitting with an LLC right now where you made $200,000 and you're staring at literally like $25,000, $30,000 of self-employment tax, you might want to consider making a late S election and running a payroll before the end of the year in order to cut your self-employment tax literally in half, right? And that's a viable strategy. I've done about 5 of those in the last week where we went, holy cow, you should be an S corp, let's make that late election, right? And the IRS typically does not turn them down, and they're very reluctant to turn them down if somewhere in the explanation you put the word COVID, right? Because just they know what's going on, and they're not turning down people who forgot to make their election because they were worried about COVID. We talked a little bit about converting the Roth retirement plan, converting the plan to Roth. I already kind of explained this before, so we'll kind of skip this one. So repairs and improvements on properties. What's the difference? Well, a repair is a deductible expense in the year you pay for it, right? So if I do a $10,000 repair, I get to deduct the $10,000 against my net rental income on the property. An improvement is capitalized and depreciated over its useful life. And that useful life could be 5 years, it could be 15 years, it could be 27 years, right? So it takes a lot longer to expense out an improvement than it does a repair, right? And there's a whole list, the IRS has a whole list of items that are always considered repairs. So how many of you, if you own apartment buildings or rental units, know that, you do that turnover. One tenant moves out, new tenant's going to move in, maybe you have to replace some flooring or repaint the place or whatever, right? Most of that stuff is considered repairs, right? Now so it can be expensed immediately. Doesn't need to be capitalized, right? So here's what happens, especially in larger projects where you have a management company, right? So I have a lot of clients that have large properties, and I get a lot of management company reports for their apartment buildings. And typically the management companies err on the side of conservatism, right? So they call everything an improvement. Everything's in the CapEx section, right? Well, if we were to do that, our clients would lose a lot of repair deductibility, right? So we get very granular with that, right? So if you're in that situation and you have a management company that's doing your books in your apartment building, take a look at what they posted to CapEx, right? Because your loss may be larger than you think it is, right? Because you may be able to go in and compare what they posted to CapEx, capital improvements, against the items that are always considered repairs, and find that you've got 10, 15, 20, $25,000 in deductible expenses you didn't even know about, right? That's the difference between having a regular accountant and a real estate accountant who understands this and is going to take the additional time and be granular enough to literally go, okay, I'm going to go line item by line item through your CapEx, and I'm going to reclass everything I possibly can from improvements to repairs. Why? More deductibility, right? So it's just one of those things that you really, that's a great year-end strategy, something that everybody who owns rental properties should be looking, what did they do? Is if I did renovations on a property, or if I did, repairs on a property, did I classify them properly? And am I missing out on deductions because I put things that qualify as repairs into improvements? So another thing that I talk about a lot with real estate investors is using entity structure to reduce audit risk, right? So we talk a lot about using LLCs to own properties, right? And having an LLC is part of an asset protection strategy. But when we talk about asset protection, at least in my experience, and is great asset protection starts with great property management, right? Because if you're a crappy property manager, if you're not paying attention to your properties, if your properties have a anything goes kind of attitude, right? You're probably negligent, right? And if you're negligent and somebody gets hurt, your insurance is not going to cover it typically, and your LLC, you're going to make it very easy for an attorney to pierce the veil. Why? Because you were negligent. So if you have great property management and you have good insurance, those are the two most important things that go into asset protection. Then we talk about entity structure, right? The other part, though, of entity structure, and this is why I love LLC partnerships, is if you own a rental property in your own name, or you have a single member LLC that owns that rental property, the details of your rental income and rental expenses are right on the face of your personal return, right on Schedule E of your personal return, where the IRS can literally look at the numbers and say, those repairs seem a little high considering the net rental income, right? They can do those kind of comparisons, right? They can run different costs against the national averages based on your personal return, right? If I use an LLC partnership, maybe it's me and my wife that own this property, and we're going to put it on a partnership return. Well, now partnership returns don't pay taxes, so they typically get audited at a far lower level than individual returns, right? So anytime I'm going to do anything aggressive right? Whether it be cost segregation or, and I'm talking legally aggressive, right? I'm gonna take the repairs deduction to the hill. All of the different things I do, I want to use a partnership. Why? Because when it hits my personal return, it's one negative number on my personal return. The IRS has no idea what makes up that negative $54,247 of rental loss that I reported for my partnership, right? Now, can they go and look at, can they go and find it? Yeah, they could, right? But most often they're not going to, right? So which is better for audit, to reduce audit risk? Having all the numbers right on the face of your personal return, or having one negative number that represents all of those numbers that flows through from a partnership? And I'm telling you right now, the partnership part is better. So that's a strategy that I recommend to a lot of investors, especially the ones who want to be aggressive with their taxes. So this is what we talked about tax planning before, year-round tax planning. When I do year-round tax planning for clients, the first thing I want to do is understand their situation. Because remember, I said everybody's different, and we tailor strategies to people's unique situations. So you have to understand their situation first. You have to understand their goals, right? Then we develop a strategic tax plan for them using the strategies that are available to them to offset both their current and their future taxes. So I'm talking to my clients right now about the recapture they're going to have in 2027, right? And I'm reminding them because clients have short memories, right? And they love that, they love when they can offset $1 million of bonus depreciation against their income, but they're a little more forgetful when it comes to when they're going to have to pay it back, right? So we're talking about those things all the time. We're talking about how to mitigate those things, right? And we're gonna prepare a multi-year projection which incorporates our plan, right? That way we can look at where you think you're going to be in different years. And this can be a rolling plan that's adjustable as your, because we could drop numbers in for 2022, 23, 24, whatever. That doesn't mean those numbers are right. That just means that's our best estimate right now. And then maybe you turn around and you do a big syndication, you get a fat acquisition fee, and now your situation is completely changed, right? Well, it's all adjustable, right? Then we're going to implement, so that's what I'm doing right now with all my clients. I'm implementing tax plans, helping them document what we're implementing, right? And then if we want to lower your taxes, we also want to make sure you're not paying any penalties. So we're going to make sure that we get it as low as possible, and then we make sure you have enough money paid in so that you're not penalized, right? So that's the process that we go through. Now I have this is an old slide, so I said I'd love to save you thousands this year. Email me, right? I'm completely sold out for tax planning this year. So, but that doesn't mean you can't do any tax planning. It means that you call your accountant and say, hey, I want to do some tax planning, because most accountants are happy to do that planning for you. And if you've got a real estate, somebody who knows real estate, that's even better. But it's better to have tax planning. In the worst case scenario, it's better to have tax planning than to not have tax planning, right? And it doesn't have to be perfect to be good, right? And even if you don't do it perfectly and you save a few $1,000s, there's still nothing wrong with that, right? So talk to your CPA, what can I be doing? Because most CPAs are geared to, hey, Ray's coming to see me in March with his stuff, right? I don't even have to think about Ray till he shows up with his paperwork, right? But if Ray calls me and says, hey, Ted, what can I do before the end of the year? I'm going to say, okay, Ray, yeah, let's talk about that. Let's see what we can do, right? So call your accountants and see what you can do. And if anything, if you take anything from this presentation tonight, take this: great record keeping and a proactive approach to your taxes are the things that are going to save you the most money overall. So I'm happy to take more questions now. No such thing as a stupid question. If I don't know the answer, I'll tell you I don't know the answer. I'm not an encyclopedia of tax rules. No, just a guy who knows more than the average person. Do you have more, Ray?
I have one more. This is a personal question, and maybe that'll give folks a chance to think about some other ones. So one of the things that I'm looking at is, I travel a lot in South Florida. We have tolls everywhere. So when I'm going out and we're looking at properties, the way I use my car this year, I was basically documenting the miles, but it was not a business car. It was a personal car that I was using. That'll be different next year, but at least for this year, what's the easy way? Is there an easy way at this point to really split that off? Because it's a pain in the butt. It's not like you get that easily when you're trying to document your miles.
Yeah, I mean, going into 2022, if you're not using a mileage app, that you like kind of hit the button when you leave and hit the button when you get there. That's a kind of an easy way to do it. You've got the phone with you. Mile IQ, I think, is one. Right? So that's if you wanted to implement a system going forward.
So I use QuickBooks, but it doesn't tell me the tolls though, right? So
no, it wouldn't tell you the toll. Do you use SunPass or what it's called?
SunPass, yeah.
Right. Okay. So you should be able to track. Does your SunPass like hit your credit card every time you need $50 worth or something?
Yeah, absolutely. Okay. I was just thinking that there was a way to kind of write off 50% or based on whatever your usage was so you didn't have.
Well, yeah. So you're going to deduct your miles and you're going to deduct your tolls. But let's say, for example, that you paid $500 in tolls and you estimate that you used your car 70% for business. Well, then you can deduct the miles and 70% of the tolls.
Okay.
In that scenario, you're going to have to estimate if you didn't keep track. Right. But going forward, you should probably keep track.
Okay.
And using an app is the easiest way. Anything else?
Ted, this is Vessi. Thank you for the presentation. I found it very informative. Actually, one more question, sort of in the line of what Ray just asked about. I'm in the process of forming my business or holding company, LLC. However, certain expenses I've already incurred, whether it's for educational events or conferences paid from my personal credit card. Does that imply at this stage the ship has sunk and I cannot deduct those? Or is there still an opportunity to consider those, again, professional development types of business related expenses?
Yeah. So you really need to, with those, if you haven't made any money in your business yet, right, then all of that kind of stuff is what I would consider startup. Right? The IRS says that you're allowed to deduct up to $5,000 of startup costs in a new business in the first year. Then I would take the rest of it. Let's say I spent $15,000. The other $10,000 that I can't expense in year one, I basically can set up as a depreciable, like an amortizable asset over 15 years as startup costs, right? Then when you make your first dollar doing whatever you're doing, that's when your startup costs end. So I mean, and if you pay for things before your LLC, I would add those up and I would add them to my LLC as a capital contribution and corresponding expense, right? So don't lose out on those, right? Now, some of them may not be allowable. So you do have to look at some of this stuff, right? So just as an example, you do have to be careful. You have to be careful with like conferences and stuff, right? What I do is I do one of two things on my clients' returns when they hand me that kind of stuff. I either call it networking or I call it business coaching. I never use the word education on a return because education really isn't tax deductible, right? So if I'm in a coaching group, that's business coaching, right? If I'm going to an event, that's networking. See the difference? So I met Ray at an event. We just happened to be like sitting on opposite ends of the couch and we started out the conversation. The whole event was about networking. The actual educational content was, it was okay, right? But what was really valuable about the event was the network, right? So as far as I'm concerned, that was a networking event. You see where I'm going?
Mhm, mhm. Okay, thank you.
You're welcome. What else, guys? All right, well, if nobody has any questions, I would say thank you so much for listening tonight. I really appreciate it. I wish you all very happy holidays. And I'll hang out, I'll hang out until you guys are done. Stop my sharing. There we go.
Oops, I was on mute. Here we go. Thank you very much, Ted. If there's any other questions, I can always kind of route those to you to see what I'll do is obviously your information, we'll put that on the YouTube, and that may trigger some additional stuff. So if I heard correctly, you are completely full right now for tech consulting. Is that what I heard?
For year-end tax planning, I am. I still can take clients for tax work this year, for tax season work. But as far as tax planning goes, I'm overwhelmed. I'm not even full.
I can just imagine. I can just imagine. But I tell you what, I saw a couple comments on there of people that are adjusting some of the things they're doing, including myself, based on what you talked about. We're going to take a look at this S corp. I'm assuming net income means after expenses, correct? So if you're expensing a lot of your stuff or depreciating a lot of it, it may not be the best approach, but we'll definitely take a look at that. Well, there's one question here. Somebody's asking about a C corp. You want to address that? Is it better?
Yeah, I mean, look, it all depends on what you're doing, right? The main decision. So I typically, I would not use C corps for anything related to real estate holdings. First of all, I would always use LLCs, right? But running an active trader business, right? Then the question becomes, do I want to use an S corp or do I want to use a C corp? I would typically use a C corp in a scenario where I ultimately would like to be able to offer pieces of the business to key employees. Maybe I'm doing something that I'd like to IPO someday or something, right? I want to be able to offer stock options or something like that. That's where the C corps really become valuable, because the problem with running a small business like a regular just sole like kind of like a sole proprietor kind of business inside a C corp is you have to take every dollar out as payroll. So it's almost like the same. It's almost like the LLC. If I've got to take every dollar out as payroll that I can personally take compensation, then I'm essentially paying the self-employment tax just like an LLC, right? Because that's the only way to get money out of a C corp. Whereas with an S corporation, I can take half salary and I can take a draw. I can't take a draw from a C corp. The draw from a C corp is considered a dividend, and that's how you end up with a double taxation situation, because you have to pay tax. If you give yourself a dividend from a C corporation, you've created taxable income that you pay tax on, and then you as the shareholder have to pay tax on the dividend income, right? So when they talk about double taxation in C corporations, that's what they're talking about. So when you want to use a C corporation is when you're building a business that you think you're going to have to, that it's going to be like a scalable kind of thing where you're going to have to bring on key employees, give them stock, that kind of thing. That's when I would use a C corp.
We really took a lot of time on this one, Ted. We went well over, and it was all good information. So I really appreciate it. I don't want to hold you up anymore. Like I said, if we got anything else, well, I'll filter it to you, and we'll make sure we get those answers back. One thing before we punch out here, our next call is going to be on the 24th of January, which is actually the 4th Monday of the month. That's a little bit different. I got to take a mandatory vacation. Otherwise, my wife's going to hang me. So we're going to be out in Puerto Rico, and it'll be right after we close out on this deal we've been working on. So she deserves it, and I deserve it. So I want to push that back, and that hopefully gives time to get the right speaker. I'm actually bringing in someone to talk about the Central Florida multifamily outlook for 2022. A lot of things happening. We back to COVID. Who knows what's going on, and then of course we have inflation, and the market may be changing here as far as the government may be injecting themselves into this to kind of tamp down on inflation. So a lot of things that can be discussed that are important for us to track. So that's all I got for next month. I don't want to give up too much, but again, Ted, thanks again for your time. I really appreciate it. I'm gonna see if I can get on your calendar, man.
All right, thanks so much, man. Have a great day. And yeah, I'd be happy to do that. Thanks.
All right.
Take care, guys. Bye-bye.